If there's one term in the investing vocab that's surprisingly little understood, it's volatility. Now, normally, volatility is associated with high risks and rapid movement in the market. And Feroze, not just that it's not understood, but it's a term that's, I think, the most feared by investors. But it doesn't have to be so, right?
Actually, people don't have to fear volatility, they have to understand it. Volatility is a measurement of risk. Basically, it tells you the magnitude and the frequency of deviation from the average return an underlying actually produces. If the security has very high fluctuation in the short run, it is said to have a higher volatility. On the contrary, if the security is moving with lesser frequency and lesser quantums in a spaced out fashion, that's supposed to have lower volatility. Imagine taking a roller coaster ride with a blindfold around your eyes. You have no idea when you are going to go up or go down, or how long will the next fall be. That's how an investment behaves when it's highly volatile. Consider this against taking a normal train ride on a hill station. There will be ups and downs, but they won't be as frequent or as scary.
From an investor's perspective, low volatility is generally preferred. Because when the roller coaster moves down fast, most people panic and jump off the wagon, taking a loss. It's difficult to sideline your emotions and hold on. But there are exceptions. People who time the market well and make money off a volatile market, buying and selling at the right times. But this is easier said than done, and it exposes the investors to a substantial risk.
Right, I think it actually poses a significant risk to short-term investors. But if you're looking to invest for the long term, then the risk is mitigated considerably. Because if you just leave your panic aside and hold on, the roller coaster is going to finish its run, and over the long periods, markets show an upward trend.
But I still prefer the train on the hill station.
Well, whatever suits you, Sumaira, there is an investment option for everyone.
Even with mutual funds, what you generally come across is average returns over a period of time. So while they give you the overall picture, it's not the whole story. And for that, we have rolling return.
Correct, Sumaira. Rolling return can tell you over long periods of time, for a specific period, what was the consistency in the delivery of return a fund actually gave an investor.